clearly one of the best ways to find investors is to put out content, make yourself an expert in investing. The same thing you're doing right now. Tim, you've asked great questions, and I'm sure that lots of people trust you because you've got the right questions. You know what you're looking for. So for everybody, social media, I think, is critically important. Put yourself out there.
Tim is one of the most authentic and genuine people I've ever met.
I sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome, everybody, to today's Capital Raising Show. I'm your host, Tim Mai, and today I have an amazing guest on the line with us. He raises a ton of money. He deals with huge institutional grade properties, and he's been doing this, not just the real estate part of it, but been in the financing world with private equity, merger and acquisitions for a long time, over 40 years. And he is the general partner and portfolio manager of several different investment companies. Alan is also a member of the Harvard Alumni Entrepreneurs Association and a founding member of the Forbes Real Estate Council. And so far, just in this fund of funds war, syndication war, Alan been doing this for 5 years and already have acquired over $1 billion in assets, ranging from multifamily, senior living, medical buildings. And so super glad to have you here, Alan. Thank you so much for doing this interview with me today.
Tim, great to be on. Good to see your face and all the other people, and happy to share my background and what I'm working on and anything else you might want to ask questions about.
Yeah, definitely. So let's jump right into it. If you can share with us a little bit about your business model, because it's not usual. It's like you have this whole marketplace, you have, your fund of funds that you do. So share with us what that business model looks like. Most everyone here are just normal syndicators, doing one deal at a time, our own deal type of thing. So love to hear about your business model.
Yeah, thanks, Tim. So again, my name is Alan Donenfeld. I'm the CEO and founder of CityVest Capital. We have a website, cityvest.com, and we are a internet-based online investment marketplace for institutional real estate private equity funds. So what that means is that we set up feeder funds, and we'll aggregate capital from a whole lot of investors at $25,000 up to $500,000, and we pool that capital so that it's a pool of a couple of $1 million, as much as 6 or 7 million. And because we have a fairly large pool of capital, when we find a institutional real estate private equity fund, which might have a minimum of, say, 500,000 or $1 million, we're much bigger than that. We're multi-million dollars. And so not only are we able to gain access to that institutional fund, but we also are able to negotiate enhanced investment terms just because of the size of our investment.
That is awesome. Share with us, what is a feeder fund and why do you have like several feeder funds, I guess? How does that work?
Yeah, so we've had 16 different feeder funds. All it means is that we've set up a SPV or an LLC entity, whatever you want to call it. We incorporate that company, we get a bank account for that entity, and we have investment documents for that entity. That entity, which, at the outset doesn't have any capital, we will then negotiate with a institutional real estate private equity fund. So each year we're looking at about 700 different real estate private equity funds, and we're going to pick the 5 to 10 per year that we believe have the best prospects. And some of our key criteria are that they be large, not a first-time fund. So we're looking for something that might be a third, fourth, or fifth fund. And when I say a fund, I'm not talking about a syndication of a single product, a single property. These are diversified funds. They might buy 5 to 20 different properties. And each of these investment managers will have literally, $500 million of realized deals that they've completed in the past and are happy to provide the audit results with an administrator confirming those results. So it's more of an institutional kind of investment. But the key is, because we're using this feeder fund model, which is, again, our own entity that we've set up, we can accept, 100 people at $25,000, which is a fairly small entry point. Well, 100 investors at 25,000 is 2.5 million. 100 investors at 100,000 is 10 million. It can get to be a relatively attractive amount of capital to be invested in the underlying institutional private equity fund.
Gotcha. Okay. So then each feeder fund, each SPV raises money for one asset. Is that correct?
That's exactly right. And that asset is diversified itself, because that asset is a fund itself, and they're investing in 5 to 20 different properties. And so typically the underlying real estate private equity fund has a 12 to 18 month capital raising period. I prefer to get in at the very tail end of that period, because they may have already raised $100 million and acquired 5 properties that are going into the fund. So I get a good solid look at what they've acquired, what are the debt terms on the properties they've acquired, etc. Not just the historical track record, but the actual fund that we will be investing in. But oftentimes, if we are the first investor in, which we're happy to do that and jumpstart the capital raising for that fund, we get extra special terms because we're maybe the first 5 million that's coming into that fund.
Gotcha. Okay. So each time that you're raising, then it sounds like you're not raising for a specific property, you're raising for a specific fund. Is that correct?
Yeah, and if it's at the beginning, then it truly is blind pool. We don't know what the assets are. I can't tell you how attractive the investments will be, but what I can tell you is the audited track record of what they've done in the past. It's realized they had an auditor and administrator, and so there's a fairly significant validation of the prior performance, although in the fund that we're actually investing in, we don't know what's in there unless we're at the, in the 11th month of a year-long capital raise, and maybe they bought 4 properties, and then we can examine what are those properties and, the projected IRR, equity multiple, look at pro forma models, etc., to get a better look at what we're actually investing in.
Gotcha. I understand. Yeah, I think the confusion I had when I first checked out your website was it looked like a marketplace where different operators post their deals, and the LPs can come in and invest into whichever deal that they want to. But the more I looked into it and the way that you explain it now, I understand it a bit more. It's just, all the deals that are on your site is your own feeder fund offering to then invest into the bigger funds.
Right. And they're all pre-vetted. So we all know that the last year has been very difficult in real estate. So we've done just 2 investments in the past year. But 2 years ago, we did 7 investments in 2020. So it just depends on if we're finding attractive investments. Obviously, multifamily is extremely hard to make money given that the interest rates are higher than cap rates. So we're right now looking at self-storage funds, and we found about 8 different funds. We're examining the different ones, looking at who's the auditor, who's the administrator, the investment management team, capital markets guy, disposition team. Each of these investment management companies are not 1, 2, 3, 5 people. They're typically 10 to 20 people within a company that's been working together for at least 5, maybe even 20 years. So it's a solid group that's been together looking to present their realized track record and raise an additional blind pool fund of money.
Gotcha. At what level of a fund do you consider now institutional grade that would have you be willing to raise money for them?
So that's a tricky question, because we often get better terms for an earlier fund manager. And usually that includes some sort of GP co-investment status. So we might get in two funds, we got 50% of the promote of the manager. So that was quite attractive, and it was a first-time fund. I think I might have said we don't deal with first-time funds. We do, but it did have $970 million of prior deal experience, had an auditor and administrator. So they had certain credentials that even though they didn't have a fund, the deal by deal business was very significant. And I would do that again if there's somebody that has significant deal by deal experience with all of the right credentials and team that's been together, etc. You know, the boxes that I need to check off though are must have an audit, must have an administrator. And what comes along with those two is usually size. You're not going to be doing a $10 million acquisition with 3 million of equity capital and then laying out, you know, 150,000 in administrator and audit, you know, expenses. It's just overwhelming on the amount of net operating income that might be generated. So it's got to have some size to accommodate the additional expenses of the corporate governance people.
Right. I'm curious as to why you choose to go with bigger funds versus smaller funds, not necessarily brand new guys, but you know, if they have, let's say, $100 million asset under management, because it sounds like your level is much higher than that. I'm curious as to have you considered working with the quote unquote smaller guys?
Yeah, absolutely. So one of the keys to a fund, and I'll get into the size in 1 second. One of the keys with a fund, particularly in this market, is having capital in the bank to be opportunistic. I'm sure everyone who's listening has gotten into a position where you found an incredible deal. You need to close quickly. And where's that capital and how fast can you raise it? And it's pretty nerve-wracking if you've gone hard on a deposit and now you're out looking for the capital. And in this market, you know, is that capital going to come in? So a fund is in a very different position if they can say, we'll put in $8 million of equity from our fund. We just want to close in 2 weeks. We have our bridge financing. We've already lined up. We've got those relationships. So you can get better pricing with opportunistic capital. But to your question, the size, everybody on this call, I'm sure, has their particular niche and they know their exact market. And we like that, right? That's the only way to find a good deal, is to know the broker who's offering out the product, right? Whatever that piece of real estate is, you have to know that guy to be fairly high on his list. Typically, funds are the highest on the list because the funds have the capital. A broker doesn't really want to work with somebody that doesn't have that money. So you have to have a very good relationship. And in whatever market you're in, you're going to know whether you want to be north of the highway, south of the highway, this good school districts, you know, gentrification, all of the ingredients that are going to make that given property an excellent property. So I'm happy to look at earlier stage investment managers, but there's got to be that track record, and the smaller deals just may not, or smaller funds may not have the size to cover the expenses of the auditor and the administrator. So it does become a little bit of a hurdle to afford the corporate governance personnel.
Right. So why is having an auditor, an administrator, why is that important? And why is that a must for you in order for you to consider raising for them?
Yeah. So when I got it started investing in real estate, which was about 10 years ago, I was actually an investment banker. I ran a hedge fund. I've owned a broker dealer for over 30 years. And so I came from a large company, corporate investment banking background. All public companies must have this PCAOA or COA audit. So it was just ingrained in me to rely upon PricewaterhouseCoopers or Ernst or KPMG. And it's just a level of trust in the institutional world that you have somebody opining on those numbers. Now, audits don't mean that the numbers are exactly right, because an auditor merely does one thing. They do testing to make sure that, a payable or the bank balances are actually what you say they are. So it's not a big thing. I think the administrator is actually a bit more important. Many funds say, but we do the administration ourselves. We've got a staff of people, and they're likely to be just as good as a third-party administrator. Third-party administrator does bring along a platform. Many people use InvestNext and various Juniper Square type platforms, Syndication Pro. There's a lot of platforms out there. You have to use those in order to get your investors distributions and quarterly reports, etc. But an administrator will bring along their own dashboard, helping you with that process. And some of the accounting does get tricky, and you want to make sure that you can get K1s out on a timely basis, and make sure that the tax accountant is well versed in state taxes, whether it's just one deal in a syndication, or it gets a little more complicated if it is a fund and all of a sudden you're dealing with multiple states and the investment manager is in another state. Some of these things do get complicated. So you do need a team of people at the investment management company that can handle these various issues that might come up.
Gotcha. That's really good. So are you a licensed, a registered investment advisor, or like a broker dealer license, or any type of licensing?
Yeah, so this isn't legal advice, but if you are earning fees and raising capital, you're likely to be required to be a broker dealer. We don't earn any capital raising fees or commissions. So we will have to be a registered investment advisor or an exempt reporting advisor, somewhat in the same category, with the Securities and Exchange Commission. But those rules actually kick in when you're at about 150 million in assets under management. We have about a little bit over 50 million in assets under management in those 16 feeder funds. As we do get over 100 million, we'll start to think about what sort of registration, an ERA, exempt reporting advisor, or an RIA. Both of those two have gotten a bit more complicated in just the past couple of weeks, because the SEC has come out with new proposals requiring full disclosure of any side letter agreements and fees and a whole number of other issues. But all of those new rules, if you want to take a look at them, are specifically for RIAs and ERAs. We're not yet there, so we will have to abide by those when we get to that size.
I see. Okay. And just for clarification, when you saying asset under management, you don't mean the properties itself. You mean the amount of funds that you have under management, right? The amount of investor money that you have under management. Is that correct?
Yeah, so we have about 1,000 investments, 1,000 investors, and that total is around $50 million of capital that's in our managed funds. And then that amount was invested in underlying funds that actually have bought properties. I know you mentioned $1 billion, but they've actually bought about $6 billion
Wow.
of property. One of them puts that number up much higher because it's a co-GP fund, and we were about 6 million in a $55 million fund, but the $55 million fund represented 1 million in 55, an average of 1 million in 55 different investments, and those were all enormous. The LPs were Goldman Sachs, Deutsche Bank, very large financial entities, where the total capitalization of those 55 different funds were about 5 billion in total. So, but all of our other funds represents about $1 billion of underlying total capitalization.
I see. Very, very cool. So these larger funds, in terms of success rate of these larger funds versus, like the smaller syndicators guys, um, as a fund of funds, do you find that these bigger funds are much safer, is a much safer investment vehicle for your fund, of your feeder funds to invest in than if you were to go investing that into syndication deals?
Yeah, so we're going to see what what the next couple of years are like, but most of our funds had fixed rate debt. So they were big enough, smart enough, wary enough of floating rate debt that that they locked in a lot of fixed rate terms. However, the other ones did not. Fortunately, virtually all of the other ones had interest rate caps, although those, those run off after a period of a year. Sometimes they're a bit longer. I mean, everybody in real estate knows the problems that we're having because interest rates went up, tripled in less than a year, and interest rate caps are expiring, and there's a lot of pressure. One thing that a fund, why a fund is a little bit safer is imagine that there's, say 10 different investments and you have interest rate caps on all 10 of them. Well, they will be expiring at different periods of time with different levels of net operating income versus a solo deal, one property that has one interest rate cap. And so if you have a problem with that deal, either the sponsor's got to put in money, there's got to be a capital call, there's no one else, standing next to you to bail you out. While in a fund, you might have 10 other properties in the fund, one of which might have fixed rate debt, and that one can use its net operating income to bail out another property because it's all in the same fund. And oftentimes the GP is a bit more sophisticated, and they, rather than doing a capital call, they may do a GP investment into the fund. So in that regard, in this environment, it is a little bit safer to be in a larger institutional fund.
Gotcha. Okay. Have any of these big funds that you invested in this market right now, have any of them had to do a capital call or that the GP did additional investment into?
No, not a single one. So
Oh,
we
wow.
haven't had
Okay.
a single capital call. Now, fortunately, all of the funds have, they're in the third, fourth, or fifth year of their life. And so many of them last year and the year before already sold some of their assets. And most of them, which had, track records of 20% plus IRRs and, over 2x equity multiples, when they sold some of the properties, they might have sold 25 to 50% of the properties, but they've already returned 50 to 100% of the capital, right? 2x equity multiple. So we're not significantly at risk. And
I see.
given some reserves that those funds started to retain back a year ago, they have the capital to get through a very difficult market right now where interest rates are so high, they're just eating up all of the net operating income and then some.
Very cool. You have a very unique business model that's different from most of us syndicators out here. What are some of the selling points that you share to your investors to invest into your type of funds versus, if someone's like, hey, I don't know if I should invest in syndications or into funds, what are some of your selling point to win them over to you?
Yeah, so I've already discussed the auditor and administrator and looking at 700 different funds and picking the strategy, management team, realized track record. So all of those are the base level of due diligence. We also, on every offering, we have a third party due diligence firm. They do background checks and all the usual examination of the underlying investment management team to make sure that there's no drunk driving arrests or bankruptcies, tax liens. They look at amount of past deals, number of deals, distribution of the employees through the investment management company, corporate governance. We make sure that there's a key man life insurance policy on that key person, just in case he dies. The investment management company will have the appropriate resources to hire someone else with the proceeds of that insurance policy. So there's a number of little things. My particular expertise is understanding real estate private equity fund documents. Unlike everybody else who's on the call, you know how to buy real estate. Frankly, I don't know how to buy real estate. I know how to read, legal documents to understand in minute detail what that waterfall actually says. And I've seen, every different kind of waterfall, and the language always changes and is always difficult to understand and can be a little tricky. There's usually makeup or catch-up payments with a manager to calculate their promote. There's also a kind of catch-up so that in a real estate private equity fund, you might have to pay in interest if the private equity fund was launched a year before, because it would be unfair for people to have invested a year ago and you come in at the exact same basis, assuming that the assets aren't revalued. So you might have to pay in an interest rate. So there's a lot of minute details in a investment fund documentation. And I get in and try to understand, what is that document saying?
Gotcha. Very fascinating. What would be a disadvantage of someone investing into your funds versus a one-off syndication?
Well, the biggest one is it could be a blind pool. So we don't know what the assets are going to be. That's if we're one of the early investors in the fund. If we're one of the later investors in the fund, they still may have uninvested capital. And so they may want to do another 3-5 different acquisitions. We don't know what they're going to be. We only know their track record, what they've already acquired. And so there could be a surprise. It happens from time to time that there might be a slight divergence from their focus of what they've already acquired. But so that would be the biggest disadvantage, it being a blind pool fund. On the other side of that, the calculation for the promote from the investor's point of view is much more fair, because if you're a syndicator doing individual deals and you have 5 different deals, it's great for the syndicator because he's going to get his 20 or 25% on each one without any sort of netting of a loss that might be in one of them. But in a private equity fund, the losses and gains are all netted against each other, and then one calculation for that 20 or 25% of profit. So you're taking into account poor performance and great performance, while in individual syndications, you're not looking at the poor performance. You might want to walk away from those, but you still got your 25% of the winners.
Right. Is there an opportunity like this? Let's say you're doing a raise, you're bringing in 5 million, and let's say there's 10 of us here. We all have feeder funds as well, and we each bring in 5 million. Is there an opportunity for us 10 to come together? That's a $10 million, or even 20 of us come together. Now we have 100 million. That would allow us to get into much bigger deals and have even better economics than what you have now.
Absolutely. But there's one little thing that I didn't describe, and that is when we seek to raise our capital in our feeder fund, and we call them access funds, we do this as a 3C1 offering. And a 3C1 offering allows up to 99 investors, all of which must be accredited investors.
Right.
So if I've set up my entity for a special purpose to invest in one fund, and if the people listening set up a special vehicle or join my entity, there's a look through to the number of investors, and I'm
Mhm.
limited to 99. So to the
Mhm.
extent that you want to go out to, create your own feeder fund into mine, because we're getting better terms, I can share some of our fees. Absolutely. And we just have to be cognizant of how many investors you have in your group. So you may want to have a minimum investment size of 100,000 and bring in 5 people. That's 500,000. And then there would be the look through for those
Gotcha.
5. But absolutely, we can work out something where we bring you in as part of the investment management team to share the compensation.
Gotcha. Okay. What about to get past that 99 investors? The same example, we each gonna write a check to the lead fund, the big fund,
Yes.
but we negotiate a term with them based on the total collective amount, even though each fund is gonna write a check. Is that a possibility?
Sure, I'd be happy to work with anyone who wants to set up their own feeder fund and invest not through us or with
But
us,
like
but
alongside,
alongside us.
yeah.
Yeah, so that you have direct access to the fund. Uh, Totally fine. I can help arrange that with the underlying fund, and I'm sure they would appreciate that to have raised more capital. One side note, it does get a little complicated, but if you set up your own feeder fund and you're investing in 3 or more funds, not one of which will represent 40% of your own feeder fund. So it's a little more diversified, a fund of funds. Then there is not a look through to the number of your investors. There's a little bit of a complication, but
I
it's a
understand.
better thing if you set up a fund of funds and you say, we're going to invest in 3 funds that CityVest presents to us, and none of them are more than 40%. We're actually doing that ourselves so that we will have a liquidity fund, and we're going to be buying in our own investors, right? Everybody wants liquidity these days. So we're going to offer our own investors liquidity, investing in our 16 access funds, and maybe some of the people on the call today want to invest in that sort of fund and taking pieces. It will be at a discount price given what's happened to values the past year, but I think that also might be attractive to the people on the call.
Right. That's awesome. So let's talk about the avatar of the investors that are ideal for you. Like who are you looking for? Who is attracted to your type of investments, your type of fund?
So they all must be accredited, and the minimum investment in our entities is 25,000. That's really the only requirement. I think once an investor gets big enough that they have their own 500,000 per investment, they can invest directly. They likely will have accounts at, Morgan Stanley, Goldman Sachs. They have lots of products that they're going to want to sell to those investors, right? We're strictly in this private Reg D market. So it's really for investors with a net worth between 1 and say 3 or 4 million that want to invest 25,000 to maybe 150,000 per investment and get some diversity. Invest in, 5 or 8 different institutional funds, get the diversification, and only come in with smaller amounts in a variety of different funds.
Gotcha. Okay. If they're an accredited, why are you only asking $25,000 minimum investment? Why not 100,000?
We actually give significant fee cuts to anybody at 100,000 or more. So we do prefer 100,000. But for example, some of the people watching this will say, this is interesting, but I don't know this guy. Let me start out at 25,000.
Gotcha.
And so we have a whole lot of first time 25,000 people. And frankly, we have about 400 investors that are now investing in their fifth, sixth, or seventh access fund, our feeder fund, because they're now comfortable with our reporting, fees, everything that we do, making distributions, right? It's a little bit of a challenge. We receive one distribution from the underlying fund, and then we have to work hard to create notcha files and get that into our bank to get the ACH distribution on a timely basis to all of our investors. We have our own dashboard, so we send out an email with a link that they sign back into, and then can see the updated quarterly report and the distribution from each of these 16 different funds.
I see. Okay. Is your business model similar to Fundrise?
I think we're most similar to a company called iCapital Network, or iCapital, except iCapital only works with registered investment advisors, and their funds are Blackstone, Carlyle Group, Apollo, right? Very, very large funds. So we're similar to iCapital, but for funds that are raising 30 to 300 million. So they are smaller funds, and we market directly to investors rather than going through RIAs, which RIAs take a lot of time to get CUSIPs and get approved on Schwab and Fidelity platforms. We're closing out our deal in 4 to 6 weeks for those 100 investors. So we don't keep this open for 3 months. We're closed. We've reached our 100 investors. We're moving on to self-storage, medical office, GP co-invest funds, whatever the next fund that we find. And we tend to do them sequentially, one by one by one. We don't have a marketplace where there's 4 offerings at the same time. There's one offering at a time. We close that, and then we work on the next offering.
I see. Okay. Let's talk about the capital raising aspect of your business. What are some of your favorite ways or favorite channels to raise money, to attract
I'll
these
bet money that this is the
investors?
favorite question for everybody that's watching. How
Yes.
do you raise capital? And it's been hard for everybody. Used to be a bit easier. Now it is really, really difficult. Everybody knows how difficult it is. So the starting point is to make sure that you've got the best product you can. That goes without saying. Everybody who's investing alongside you wants to know that you got skin in the game. So you obviously have to be putting up some money, not just taking out fees and reinvesting it. You got to be committed to the project, have the experience. Clearly, one of the best ways to find investors is to put out content, make yourself an expert in investing. The same thing you're doing right now. Tim, you've asked great questions, and I'm sure that lots of people trust you because you've got the right questions. You know what you're looking for. So for everybody, social media, I think, is critically important. Put yourself out there, post as much as you can, write white papers in whatever your expertise is, whether it's multifamily in a given city, whether it's Section 8 housing. There's lots of different niches. Make sure you're the professional. Post often, join groups like I'm in the Forbes Real Estate Council. You got to post content there, post on LinkedIn, post in Facebook, create mastermind groups, make friends, go to conferences, have co-investors that like you. People will invest with you if they like you, right? That goes without saying. So you got to put yourself out there and meet a lot of people. And most likely that means going to Tim's capital raising conference, the 12th to the 14th, because you're going to meet a ton of people there. And they're the right kind of people to meet and co-invest with, make friends, find out what they're doing. And that's how you're going to raise money for your own deals.
And thank you for that plug. It's really awesome.
It's true.
Thank you. Yeah, yes, it sounds like, positioning yourself as an authority when it comes to investing and creating content is a big part of your business and like the way you position yourself in the marketplace. Do you also go on a lot of like podcasts and speaking engagements as well as another way?
I do some. Obviously, this is one. So I do some, probably not enough. Um, to a certain extent, I don't want a lot of competitors figuring out my niche, but it is crucially important to do that. And as a company with an online platform, we do spend quite a bit on Facebook and LinkedIn in sponsored ads. And a lot of people do. So you're competing with lots of other syndicators, funds, platforms. You'll find CrowdStreet and Equity
Right.
Multiple and Realty Mogul. They're all advertising. And, Cadre spends, literally $1 million a year or more. You mentioned Fundrise before. They were just sanctioned because they had paid people a total of $6 million to have testimonials
Oh,
on YouTube.
wow.
I don't know if you saw that. It was
No,
about
I did not.
so they paid people $6 million for testimonials on YouTube. And that's how they've gotten so popular, because you see these testimonials and you think Fundrise is great. Fundrise is terrific. The returns are frankly a bit mediocre because their costs are high, but they certainly have attracted hundreds of thousands of investors. But they spent $6 million paying people to say great things about them. That obviously was helpful for them attracting a lot of investors.
Wow. For a big company like that to do something like that, I mean, I'm curious as to how that happened. Yeah.
Well, it probably made sense at the time. They raised a lot of capital, and they have grown. I mean, I don't know how much they manage, but it's multi-billion dollars in asset management, and so they clearly had the capital to do it, and it has been a successful strategy. They merely had to pay a fine. Good for them. They figured it out, and the cost to them at the end of the day was relatively small.
Gotcha. All right. Very interesting. I did not know that at all. Um, awesome. And in terms of the type of tools that you use in your business to manage all of these funds, so what is the portal or the platform that you use to manage all of your feeder funds?
Yeah, that's a great question. So we use HubSpot. That's where we do our marketing to our 40,000 email constituents. About, again, 1,000 are actual investors. So all of the others are people that have signed up at the website, expressed an interest. I've got 31,000 LinkedIn connections. So we're constantly sending out emails, posting, putting out white papers on why invest in medical office. I have one coming out soon on why invest in self-storage, and people will see it. HubSpot will collect all of that information. When someone clicks on learn more, we get their email, phone, and name from Facebook and LinkedIn. That goes into our database. They will get our next email and all of our future marketing. So HubSpot collects that. Then when we're in the marketing of an offering, we send out the emails. When people click on the email, that's an open. We know who's opened. HubSpot will track that. When they click on the email and go to the website, we know that. We know which pages they go to. We know how long they've spent at the website. If they click on looking at documents, we know who looks at documents. So we begin to develop a funnel of the level of interest, because we're working at scale, 40,000 people. So on 40,000 people, we can't possibly call 40,000, but we can call 300 if we know that 300 people looked at documents. So it's really operating at scale, and HubSpot manages all of that. HubSpot is excellent, but it's extremely expensive. I also on the side use Nimble. They've got a pretty good ability to track people. They have a funnel. So there are some much cheaper resources. These are just the ones that I use. Salesforce I used to use. It was far too complicated for us to use. But there are a whole lot of other programs to track investors. Might want to try Nimble. The one interesting thing about Nimble is when you put in their email and phone and where they live, Nimble will find their social media. So Nimble finds their LinkedIn page so that when you do end up calling them, you know something about them. You can click into their social media and know something about them, to speak to them about what they might be interested in.
That's very cool. And then what about the fund management software, like a portal? What portal do you use?
So we've spent quite a bit of money and built our own portal.
Oh, okay.
So all of that management of tracking investors, and we call it our customer relationship database. So HubSpot feeds into that homegrown system. We have a CTO that actually had used it to help manage private equity funds distributions. And that's exactly what we're doing. So all of the emails that we send out, we know every email that we've sent out from the beginning. So we can track every single email. What did it say? We actually even know how long people have looked at the emails. So it's a homegrown system, but it's very similar, a baby version of what Juniper Square, AppFolio, InvestNext, all of those kinds of systems do something similar in a much bigger way, but a canned product way. We have total control over our system because we built it ourselves. So if we need specialized information from our system, you might not be able to get that at Juniper Square, but we can get that out of our system because we control our own data.
Right. That's really good. So you've been, in the market for a long time. What is your crystal ball telling you about this particular market that we're in right now, and where do you see it's heading?
So it looks like we're not going back to the interest rate levels of the past 10 years, not for the foreseeable future, although there's always that black swan and there's always, a great financial crisis. It happens. Maybe it's in 15 years, but I see us at or, near these same sort of interest rate levels for at least another 2 years. Maybe they drift down a little bit. So I think we've all heard this new mantra of stay alive to 25. Maybe by 25, we start to see long-term rates back down to 5.5%, 6%. I just don't see them coming down to 4%. We'd have to have another deep recession. And I think we all see that unemployment is still extremely low. There's just not a hard landing that we're likely to see, which might propel the Fed to reduce interest rates significantly. So I just don't see interest rates coming down. However, I do see that cap rates will continue to drift up. We all know that we have two different camps, the buyers and the sellers, and they are not speaking. They're not seeing eye to eye. The buyers want to buy properties at a higher cap rate, and the sellers are still asking high prices, and that will continue until the investors and sponsors have lots of distress, and there will be distress. There will be a time that these interest rate caps expire and there's no capital to put in, and the banks will take back the properties and put the properties back on the market, because regional banks will have their own sort of distress. They will have their own bad debt, and they're not going to hang on to these properties. They're going to put them right back on the market as quickly as they can. I mean, frankly, banks are in a world of distress of their own that we haven't yet seen until next year. But as soon as they take back properties, they're going to be selling those properties, and that will be at 6.5% cap rates. And I think we're all salivating to see those properties, but recognize that you're going to have to be able to support debt payments for the next maybe 2 years at escalating rates. Even if they're floating rates, those rates are going to be increasing. So it's going to be a challenging 2 years, and hopefully everybody can get through that period of time. One of the reasons why we're starting this liquidity fund is for, which is a new fund of CityVest. It's called Class CityVest Liquidity and Secondaries Fund, because everybody's going to need liquidity and to move their capital around, maybe selling some assets, using that capital to shore up the GP capital or pay down debt of some other properties. So it's going to be a challenging time. Our fund will help GPs and LPs obtain that liquidity, purchasing secondaries. There's also, GP continuation funds, where some funds might come to the end of their, 7-year life, and they're going to need somebody to come in at a late stage to buy those properties. So we know there's going to be distress. We're going to be one of many funds that will help the distress that's out there and help everybody get through to 25, might even be into 26, until rates come back down a little bit. And then there's a better equilibrium between buyers and sellers.
I see. Very interesting. Wow. How big is this fund that you just mentioned?
Yeah, so CityVest Liquidity and Secondaries Fund is actually going to be a $20 million fund. It'll be our biggest fund. We're actually not letting in $25,000 investors. It's going to be $100,000 minimum, but there are fee discounts for much larger investors. So we are looking to raise more, because the amount of capital needed for liquidity and secondaries, I think, is going to be a much greater capital need.
Right. Yeah, I agree with you. I think I'm looking forward to staying in touch and hearing more about your fund. So when are you launching it?
It'll probably be at the end of October, with some fee discounts for everybody that invests prior to the end of this year. So to get that initial
Very cool.
capital in, and by the way, we're going to have a 12% pref. So we're not going to make anything until investors get 12%, which is a very high hurdle. But with distress, we're expecting, one of the things that happens in the secondary market, if you're 3 or 4 years into a fund, you've gotten beyond what's usually called in the private equity world the J curve, right? In value add, you might have 2 to 3 years where you're renovating. You have 25% of your units per year are not even rented out, right? You're doing your renovation, and then you're trying to get higher rents for a lot of properties. So there might be in most funds, there's a J curve, low income in the first couple of years. But in a fund that's already been out there for 3 or 4 years, you might be beyond that J curve. So there's a shorter duration. There might only be 3 years left in the fund. And hopefully that 3 years puts us into 2026. When rates start coming back down, the ability of these funds and investors to sell their properties at what we hope would be higher valuations given lower cap rates in 2026.
I see. That's very cool. I love, yeah. I mean, I love, your plans and your approach and your master plan to go about taking advantage of this market. Alan, it's been a pleasure and just been a blessing to be able to interview you. For the folks that are listening, wanting to connect with you, invest with you, learn more from you, follow you on social media, where would you
Yeah.
like to send them?
Yeah, so the website is cityvest.com. My email is Alan, ALAN, at cityvest.com. There's, a learning center at the website, or just email me a question. We'll figure out a time to talk. And as you can tell, I'm not so much doing this for what I make from the CityVest funds. I started the company, to be perfectly frank, for a family member who was not making a lot of money in the stock market. And we all know that real estate is far and away the best investment. I wanted to get him into investments. We didn't do particularly well investing in singular deals. And so I moved up to the institutional funds. We've done much better. And so now I'm making it my purpose to get investors into institutional funds as a way to preserve, protect, and grow their own capital. I don't make a lot from it. It's a gift to other people to make sure that their money is safe.
I love that mission. That is so awesome. Well, again, Alan, thank you so much for doing this interview with me. Really appreciate you.
Thank you, Tim. I appreciate you inviting me, and I'm glad that I could share what I'm doing with everyone listening.